Two people turn 40 in the same year, in the same city, working similar hours. One of them earns $250,000 a year. The other earns $90,000. You'd assume the higher earner is in better shape. Retirement funded, debt gone, future secured. But that's not what happens. The one earning $250,000 is still living paycheck to paycheck. Nice house, nice car, and a bank account that resets to zero every month. The one earning $90,000 owns their home outright, has a fully funded retirement account, and hasn't worried about a surprise bill in over a decade. Same economy, same tax system, same starting point in their 20s. Both worked hard. Both made reasonable decisions along the way, at least on the surface. Completely different financial lives. One of them lies awake some nights doing math that never quite works out. The other hasn't thought about money as a source of stress in years. Not because the bills stopped coming, but because the plan was already built to absorb them. The difference wasn't income. It was the financial goals they hit, quietly, without fanfare, before they ever turned 40. Nobody throws a party when they finish an emergency fund. Nobody posts about paying off a credit card. But those unglamorous milestones are the actual difference between financial freedom and financial anxiety, and almost nobody explains them in order. That's what this video does. So here are the 9 goals, counting down, with the most important one saved for last. Goal 9. Debt freedom. This is where most people get it wrong. They think of debt as one category, when really there are 2 completely different games being played. Low-interest debt, a mortgage, a reasonable auto loan, can coexist with investing because the return you'd earn in the market often beats the interest you're paying. High-interest debt, credit cards especially, doesn't work that way. When you're paying 20% plus interest, no reasonable investment return outpaces that. Every dollar sitting in that kind of debt is a guaranteed loss disguised as a monthly minimum payment. Priya carried about $9,000 in credit card debt through most of her 30s. Not from one reckless purchase, just years of minimum payments that never actually shrank the balance because interest kept eating whatever she put toward it. When she finally calculated it honestly, she'd paid more in interest over 8 years than the original amount she'd borrowed. That's the quiet tragedy of high-interest debt. It doesn't announce itself as a crisis. It just sits there, month after month, converting future wealth into interest payments to a bank. This tiny decision, carrying a balance instead of clearing it, quietly costs people hundreds of thousands of dollars over a lifetime, once you factor in the investing that money could have done instead. Goal 8. The emergency fund. Most people think an emergency fund is optional, something you build eventually, once the fund spending is out of the way. It isn't optional. It's the goal that determines whether every other financial decision you make is a choice or a reaction. Here's the mechanism. Without a cash buffer, every unexpected expense, a car repair, a medical bill, a layoff, gets solved with debt. And debt taken on in a panic is always the most expensive kind because you don't have time to shop for better terms. You just need money now. Reza was a mechanical engineer earning a comfortable salary in his late 20s. No debt, decent retirement contributions, seemingly on track. Then a round of layoffs hit his company. With no cash reserve, he financed 3 months of rent and groceries on 2 credit cards at 24% interest. It took him almost 2 years to pay that off. 2 years where his investing basically stopped because every spare dollar went toward debt instead of his portfolio. That's the real cost of skipping this goal. It's not the emergency itself. Emergencies happen to everyone. It's that without a buffer, every emergency turns into a multi-year detour. There's also a psychological cost that rarely gets mentioned. People without a cash cushion make worse decisions under stress, not just financially riskier ones. Job offers get accepted out of desperation instead of fit. Bad landlords get tolerated because moving isn't affordable. An emergency fund doesn't just sit in a bank account. It buys you the ability to say no. Goal 7. Insurance protection. Insurance is the least exciting goal on this list, and that's exactly why people skip it. Here's the psychology behind it. Humans are terrible at pricing low-probability, high-impact events. We overestimate the chance of a break-in and underestimate the financial devastation of losing an income earner or becoming unable to work. Insurance isn't a bet that you'll need it. It's what keeps one bad event from erasing everything else on this list. Daniel, a father of 2 in his mid-30s, always meant to get life and disability insurance once things settled down. He never got around to it. When he was unexpectedly hospitalized for months with a serious illness, his family didn't just face medical bills. They faced the total loss of his income with nothing to replace it. They survived by draining a retirement account a decade early, permanently shrinking what should have been decades of untouched compounding. The long-term consequence of skipping insurance isn't about the premium you save today. It's that a single uninsured event can undo 15 years of otherwise perfect financial decisions. And the people who need it most, anyone with dependents or debt tied to their name, are usually the same people who feel like they can't afford the monthly premium. when in reality, it's often the cost of little more than a streaming subscription or two. Once your downside is actually protected, the real wealth building can start, but only if you build the right habit around it. Goal 6. Consistent, automated investing. Here's what almost nobody realizes about investing. The people who build real wealth are rarely the best stock pickers. They're the most consistent depositors. The behavioral trap is this. Most people try to invest around market conditions. Buying when things feel good, pausing when the news is bad. That instinct feels rational in the moment, and it's almost always the wrong call because it means missing the exact recovery days that drive most long-term returns. Marcus started investing at 24 with a modest automatic transfer into an index fund every payday, never checking the balance, never adjusting based on headlines. His coworker, earning a similar salary, tried to time his contributions around dips and news cycles, often pausing for months at a stretch. 15 years later, Marcus's account had meaningfully outgrown his coworkers, not because he picked better investments, but because he never stopped feeding his. Part of this comes down to a simple quirk of human psychology. Losses feel roughly twice as painful as equivalent gains feel good. So when markets drop, the instinct to protect yourself by pulling back feels responsible. Even though historically it's the exact moment consistent investors are quietly buying more shares at a discount. This is where most people get it wrong. They treat investing as a decision they make. It should be a system that runs without them. But a growing portfolio only tells half the story. The other half is where you choose to live. Goal 5. The housing decision. Homeownership isn't automatically a financial goal, despite what everyone assumes. The real goal is making an intentional housing decision instead of drifting into one. Here's the trap. People buy homes based on what a lender approves them for, not what actually fits their financial plan. A mortgage that consumes too much of your income doesn't just limit your lifestyle. It quietly starves your investing because every extra dollar goes to a house payment instead of a portfolio. Sarah and her partner bought a home in their early 30s that stretched their budget to the edge of what the bank allowed. On paper, they were homeowners building equity. In reality, they had almost nothing left each month to invest, and it took nearly a decade to build any assets outside the house itself, assets they could actually access before retirement age. There's also an opportunity cost problem people rarely calculate. Equity trapped inside a home you can't easily sell isn't the same as money in an investment account. It doesn't compound the same way, and you can't quietly redirect it toward a market downturn or a better opportunity when one shows up. Compare that stretched purchase to renting deliberately while investing the difference, or buying well within your means. The goal was never own a home by 40. The goal is making sure your housing decision doesn't quietly cancel out every other goal on this list. Once your biggest monthly expense is under control, the next question becomes, is your income even coming from one place? Goal 4. Multiple income streams. This changes everything, and most people never test it until it's forced on them. Relying on a single paycheck isn't just a cash flow issue. It's a concentration risk, the same way putting all your investments in one stock would be. If that one income source disappears, your entire financial plan disappears with it. Angela worked in marketing for over a decade, fully dependent on her salary. When her department was restructured, she had zero income for 4 months. Her colleague, who had spent 2 years building a small freelance side business, earning even a modest few $100s a month, kept steady cash flow through the same layoff, and used the gap to grow that income into a second real career. The long-term consequence isn't just about surviving a layoff. People with multiple income streams tend to invest more consistently and recover from setbacks faster because they're never one bad quarter away from pausing everything. It doesn't need to be dramatic. A small consulting project, rental income from a spare room, dividends from a taxable brokerage account all count. The specific source matters less than the fact that your household's financial survival no longer depends entirely on one employer's decisions. But income streams only matter if you're actually tracking whether they're moving you forward. Goal 3. A real net worth milestone. Most people can tell you their salary instantly. Very few can tell you their net worth. That gap is the real problem. Income tells you what you earn. Net worth tells you what you're actually keeping. And it's the only number that reflects every decision above, all in one place. A useful benchmark by 40 is having built assets worth roughly 1 to 2 times your annual income. though the exact number matters less than the habit of tracking it at all. Tom and his sister grew up in the same household with similar starting salaries. Tom checked his retirement account once a year and otherwise ignored his overall finances. His sister tracked her net worth every quarter. Every account, every debt, added up in one spreadsheet. By 40, she wasn't just wealthier, she'd caught problems early, like a high-fee investment account Tom never noticed had been quietly underperforming hers for 6 years straight. The consequence of skipping this goal isn't dramatic. It's slow. You simply don't know where you stand, so you can't course correct until the damage is already done. Net worth is also the one number that can't be faked by appearances. A leased car and a large house say nothing about whether someone is actually building wealth or quietly renting the illusion of it. But even a healthy net worth can be quietly wiped out by one thing almost nobody in their 30s thinks about. Goal 2. Estate planning basics. This is the goal that gets skipped more than any other on this list because it feels irrelevant. Something for retirees, not someone in their 30s. That assumption is expensive. Estate planning at this stage isn't about writing an elaborate will. It's about 3 basic things: a simple will, updated beneficiary designations, and power of attorney documents. Without them, decisions about your money, and your children, if you have them, get made by a court instead of by you. Wei and his wife had 2 young kids, a mortgage, and solid retirement savings, but no will and outdated beneficiary forms from a job he'd left years earlier. When he passed away unexpectedly, his retirement account legally went to a beneficiary he'd named a decade before, not his wife. And untangling it took his family over a year and thousands of dollars in legal fees during the hardest period of their lives. The long-term consequence isn't really financial in the traditional sense. It's that every other goal on this list, the investing, the net worth, the income streams, can all be quietly undone in an afternoon of paperwork nobody bothered to update. And unlike most financial mistakes, this one can't be fixed after the fact. There's no catching up on an estate plan once it's needed. And that brings us to the goal that ties every single one of these together. Goal 1, knowing your number. Here's the real problem with how most people approach money. They chase goals without ever defining what they're actually working toward. An emergency fund, no debt, investments, insurance, income streams, a healthy net worth, estate documents, all of that can exist, and someone can still feel financially anxious because they've never calculated the one number that actually matters. What does financial freedom cost specifically for their life? This is the difference between accumulating money and building freedom. Knowing your number means calculating roughly what your investments need to generate, through growth and eventual withdrawals, to cover your real annual expenses without a paycheck. For most people, that turns out to be a multiple of their annual spending, not their income, which is itself a revelation because it means the number isn't fixed. Spend less deliberately, and the finish line moves closer. Once you know that number, every financial decision becomes measurable. You're not just saving, you're closing a specific, calculated gap. The second half of this goal is just as important: mastering your cash flow, knowing every month exactly how much is coming in, how much is going out, and how much is left to move toward that number. This is what separates 2 people with identical incomes. The one who knows their number and controls their cash flow is quietly getting closer to freedom every single month. The one who doesn't is just earning a bigger paycheck to spend a bigger amount. Remember the 2 people from the start of this video? The one earning $90,000 who reached 40 debt-free with a paid-off home and steady investments wasn't lucky. At some point in their 30s, they calculated their number and built their monthly cash flow around closing that gap, deliberately, consistently, without needing a 6-figure income to do it. The person earning $250,000 never did that math. They just earned more and spent accordingly, which is why a bigger income never turned into more freedom. It all connects. None of these 9 goals exist in isolation. That's really the entire point of this video. An emergency fund protects you from needing debt. Clearing debt frees up the cash flow to invest consistently. Consistent investing only builds real wealth if your income isn't wiped out by an uninsured event. Multiple income streams and a controlled housing payment give you more to invest in the first place. Tracking your net worth tells you whether any of this is actually working. Estate planning protects everything you've built from being undone by a single oversight. And your number, along with the cash flow discipline to reach it, is what turns all of the above from a checklist into an actual plan. Miss just one of these, quietly, and it slows down everything connected to it. That's why the people who reach 40, financially secure, rarely talk about one big breakthrough. There wasn't one. There were 9 quiet decisions, made consistently, years before anyone was paying attention, most of them unremarkable enough that nobody watching from the outside would have noticed anything happening at all. By the time you turn 40, your financial life is usually the result of thousands of small decisions, not one big break. The good news is that the next decision is still yours to make. If you found this helpful, subscribe for more videos that break down money using real numbers, not myths.